America's debt. It's a topic that dominates the airwaves, a constant source of anxiety and debate. News channels dissect it, analyze it, and present it in a way that often feels both overwhelming and strangely abstract. Huge numbers flash across the screen, a dizzying array of statistics and projections, endless debates rage on, with economists and pundits offering conflicting opinions and dire warnings. There's a pervasive sense that the US government is spending like a college kid who's just been handed a brand new credit card, with no spending limit in sight. A carefree attitude towards fiscal responsibility. We hear constant chatter about debt ceilings, budget deficits, and interest payments so astronomically big they could buy every single avocado in California, and probably a few other states too. It's a staggering amount of money. Meanwhile, China is often portrayed as the responsible lender, the prudent saver, a nation carefully managing its finances. They're even seen as the owner of a significant chunk of US debt, holding our financial future in their hands, or so the narrative goes. On paper, China's government debt-to-GDP ratio appears quite modest, especially when compared to the seemingly out-of-control figures coming out of America, but that's only what we see on the surface. It's a carefully constructed image. Dig deeper, and you'll quickly discover that China's debt problem is not just bigger than America's, it's far more complex and insidious. It's hidden beneath layers of opaque accounting, sprawling across local governments and state-owned enterprises, and potentially catastrophic for the global economy. The real story here isn't simply about which country borrows more money, but about how each country's financial system either hides or reveals the true extent of the risks involved. Transparency is key. This is a story about perception versus reality, about the delicate dance of international politics, and about a potential global financial crisis that's been brewing for years, hiding in plain sight, waiting to erupt. America's debt is refreshingly straightforward. It's a topic that's constantly in the news, debated in Congress, and analyzed by economists. Unlike some other nations, the United States operates with a high degree of transparency when it comes to its financial obligations. The federal government borrows by selling treasury bonds to investors worldwide. These bonds are essentially IOUs, promising to repay the borrowed money with interest at a future date. The global demand for these bonds reflects the world's confidence in the U.S. economy. This borrowing funds everything from the military, ensuring national security, and projecting American power around the globe. Defense spending is a significant portion of the federal budget, and borrowing helps to cover these costs. To national parks, preserving natural wonders and providing recreational opportunities for millions of Americans. These parks are a national treasure, and government funding ensures their upkeep and accessibility. And it's all public, debated, and tracked. Every dollar borrowed and spent is subject to scrutiny by lawmakers, the media, and the public. This transparency is a cornerstone of American democracy. State and local governments also borrow, primarily through municipal bonds, to fund infrastructure projects, schools, and other essential services for their communities. But their debt is a small slice, about 12% of GDP. The vast majority of government debt is held at the federal level, reflecting the national government's broader responsibilities. Add it all up, and U.S. government debt is around 132% of GDP. This is a substantial figure representing the accumulated borrowing over decades to finance government programs and respond to economic crises. It's a big number, but it's visible and transparent. The details of the debt are readily available to anyone who wants to examine them, fostering accountability and informed public discourse. The process is messy, with political wrangling and competing priorities, but lenders know what they're getting into, understanding the risks and rewards of investing in U.S. debt, and trust the U.S. to pay its bills. This trust is built on a long history of honoring its financial obligations and maintaining a stable economy. That's why America can borrow so much, so cheaply. The strong demand for U.S. Treasury bonds keeps interest rates low, making it more affordable for the government to finance its operations. The debt is a slow-moving train, a long-term challenge that requires careful management and responsible fiscal policies. Everyone sees it, debates it, with economists, politicians, and citizens all weighing in on the best course of action, and plans for it. The government develops budget projections and economic forecasts to assess the impact of the debt and formulate strategies for managing it. It's a serious problem, but not a hidden one. The transparency surrounding the debt allows for informed decision-making and public accountability. In contrast, China's debt is a shadowy, complex beast. The lack of transparency and the intricate web of financial relationships make it difficult to assess the true extent of the problem. Its true scale is hidden, making it far more unpredictable and potentially more dangerous to the global economy. Let's look at how that works. We'll delve into the complexities of China's debt and explore the factors that contribute to its opacity. China's official central government debt looks modest, but that's just the tip of the iceberg. The real debt is buried in local governments and state-owned enterprises. Local leaders are pressured to boost growth, so they borrow heavily, often through off-the-books local government financing vehicles. SOEs, thousands of them, borrow to fund government projects, blurring the line between public and private debt. The government directs these entities to build infrastructure both at home and abroad without putting it on the national budget. If any of these borrowers get into trouble, the central government is expected to bail them out. This creates a web of implicit guarantees. Debt that's technically private but functionally public. The result, a massive tangled debt system that's nearly impossible to track. And the numbers are staggering. When we talk about national debt, the figures can be staggering, almost incomprehensible. To truly grasp the scale of the financial challenges facing major economies, we need to delve into the details and dissect the numbers. So, let's try to quantify China's real debt. It's a topic shrouded in complexity and often obscured by official pronouncements. Unraveling the true extent of China's financial obligations requires a careful examination of various layers of debt, some of which are not immediately apparent. Officially, China's central government debt is reported to be around 84% of its gross domestic product, or GDP. This figure, on its own, might seem manageable, and even paints a picture of fiscal responsibility when compared to other nations. Indeed, it's lower than America's, which stands at approximately 132% of GDP. At first glance, this comparison might lead one to believe that China is in a stronger financial position than the United States. But, and this is a crucial but, we need to add in local government debt to get a more accurate picture. The debt held by local governments in China is a significant factor that often goes underreported or is simply overlooked in broad comparisons. This local government debt is estimated to be around 76% of GDP. This substantial amount reflects the borrowing undertaken by local authorities to fund infrastructure projects, social programs, and other initiatives aimed at stimulating regional economic growth. So, if you combine the central government debt with the local government debt, you're already at 160% of GDP. This combined figure provides a more realistic assessment of the overall debt burden shouldered by the Chinese government. But the story doesn't end there. Now, we need to factor in the debt held by state-owned enterprises, or SOEs. These entities, which are owned and controlled by the government, play a significant role in the Chinese economy, and that debt is estimated to be about $30 trillion. This massive sum represents the accumulated borrowings of SOEs to finance their operations, investments, and expansion plans across various sectors. That's more than China's entire annual output, highlighting the sheer scale of SOE debt and its potential implications for the country's financial stability. When you consider all these factors, that pushes China's effective government debt to over 300% of GDP. This is a significantly higher figure than the officially reported central government debt and paints a far more concerning picture of China's overall financial health. That's more than double America's, revealing a stark contrast in the debt burdens carried by the two economic superpowers. And if China's GDP is overstated, as some analysts suspect, due to data manipulation or inflated reporting, then the real ratio could be 400% or even higher. This would place China in a precarious financial position with a debt burden that could potentially trigger a crisis. To illustrate this point, imagine a friend who claims to have a modest amount of debt, but is secretly responsible for mountains more, hidden away in various accounts and obligations that they haven't disclosed. Suddenly, their financial situation looks far more terrifying than initially portrayed, doesn't it? That's China. The official figures tell one story, but the underlying reality is far more complex and concerning. It's a debt load that dwarfs America's, despite what initial comparisons might suggest. But it is hidden in plain sight, obscured by layers of complexity and a lack of transparency. The difference isn't just the numbers themselves, although the sheer scale of the debt is alarming. It's how those numbers are buried, concealed beneath layers of opaque accounting practices and a lack of independent scrutiny. America's debt, for all its magnitude, is at least public and openly debated, subject to scrutiny by lawmakers, economists, and the media. China's, on the other hand, is largely concealed, tangled in a complex web of state-owned enterprises, local government financing vehicles, and off-balance sheet liabilities, making it potentially explosive. The risks associated with this hidden debt are enormous, not just for China, but for the global economy. And the consequences of a potential debt crisis in China could be global, rippling through financial markets and impacting economies around the world. Where did all this borrowed money go? In China, it poured into real estate. With few other investment options, Chinese households and local governments funneled savings and debt into property. Real estate became the world's largest asset class, with prices in cities like Beijing and Shanghai reaching 30-35 times the average income. Developers borrowed billions, pre-sold unbuilt apartments, and relied on ever-rising prices. Local governments sold land to developers, using the proceeds to fund projects and pay their own debts. The system became a self-reinforcing cycle. Borrow, build, sell land, repeat. Everyone, families, developers, local officials, was all in on property. But now the cycle is faltering. The house of cards is starting to wobble. With so much money created, why hasn't China seen runaway inflation? Chinese consumers are famously frugal, saving much of their income for education, healthcare, and most of all, property. Consumer spending is low, so the flood of new money didn't drive up everyday prices. Instead, it all went into real estate, inflating asset prices rather than consumer goods. This allowed the government to borrow and spend massively without immediate inflation. State-owned banks lent at low rates, creating a feedback loop. More debt, more building, more money. The system worked until now. Relying on a single overinflated asset class is risky. If property values fall, the whole system is at risk. China's debt-fueled growth has reached its limits. The pressure is building. Despite all this risk, China borrows at rock-bottom rates lower than the US. Why? Because China's financial system isn't a free market. Capital controls keep money trapped inside the country, so Chinese investors have few choices. State-owned banks are forced to lend to the government at low rates. The government is essentially its own lender, setting the terms. With the stock market volatile and real estate shaky, government bonds are the only safe option. This keeps borrowing costs low but hides the true risk. If confidence cracks, rates could spike and the debt burden would become unmanageable. The system's stability is an illusion propped up by control, not market trust. The danger is hidden, but very real. China's growth has been built on hidden debt and a real estate bubble. Now cracks are showing. Developers default, construction stalls, and property prices fall. If the bubble bursts, households lose savings, developers go bankrupt, and local governments can't pay their debts. Local defaults could trigger a banking crisis, forcing the central government to step in. That means either taking on all the hidden debt or printing more money, risking the inflation they've avoided so far. China owns vast assets, but selling them would mean losing control or crashing the market further. The government is trapped. Every solution has painful consequences. There's no easy way out. The debt trap is tightening. The world is watching. America and China face different debt crises shaped by their unique systems. America's debt is public, messy, and debated, a crisis of overconsumption and political gridlock. The risk is a slow decline, rising rates, eroding confidence, and paralysis. China's debt is hidden, controlled, and tied to overinvestment. The risk is sudden collapse, a property crash, banking crisis, and exposure of decades of bad loans. Neither country is winning. A Chinese debt crisis would send shockwaves worldwide, hurting everyone. America's problems are visible, China's are concealed. But hidden problems are often the most dangerous. Both nations must confront the consequences of their choices. The world can't afford to ignore the risks any longer.